The market is closed for Plug Power Inc. stock, which last traded at $2.69 on Friday, October 31, 2025, closing up $0.04 or approximately 1.51% on the day. That one-day upward movement, while seemingly modest in absolute terms, is a critical piece of the puzzle here, especially against a recent backdrop of high volatility and overall downward pressure. The conventional market narrative around Plug Power right now is one of perpetual hope and painful dilution. It's the poster child for the green hydrogen future that always seems to be 6 months away, a stock perpetually swimming against a current of negative cash flow and high capital expenditure. However, the insight that should grab your attention immediately, the one that challenges this common ground, is the sheer institutional volume we've seen in the last few trading weeks, coupled with a highly strategic recent capital raise. This isn't just retail trading on hope. The whales are positioning, specifically around a perceived inflection point in their green hydrogen production network that most investors are overlooking. Let's establish that common ground first. When people talk about Plug Power, they acknowledge the company is a hydrogen solutions provider, primarily known for its hydrogen fuel cell systems used in electric material handling vehicles, like forklifts in massive distribution centers for companies like Amazon and Walmart. The vision is compelling: an integrated green hydrogen investment, from production, electrolyzers, to liquefaction, logistics, and the fuel cell technology itself. The expectation is that government incentives, like the $3 per kilogram production tax credit under the U.S. Inflation Reduction Act, will eventually make green hydrogen cost competitive, and that Plug's massive capital deployment into building gigafactories for electrolyzers and multiple hydrogen production sites will translate into an insurmountable scale advantage. But the reality is that for too long, this stock has traded on promises and press releases, not profits. The market has been brutally efficient at punishing every operational delay, every cash burn quarter, and every need for more capital through warrant exercises or stock sales, which is where the dilution narrative originates and why we've seen significant pullbacks from highs. The stock has been a high-risk, high-reward play, and for many investors utilizing platforms like Robinhood stock trading for quick access or attempting self-investing without adequate research, the downside risk has been substantial. Now let's focus on the recent stock movement that challenges the dilution-only view. While the stock has trended lower recently, especially after its strong surge earlier in the year, the trading volume is what we need to zoom in on. We saw trading volume hitting roughly 94.5 million shares on Friday, which is still a very high number, indicating significant market activity. This large volume, even on consolidation days, isn't typical for a stock that's simply fading out. What's more significant is the institutional activity data. Major holders like Vanguard and BlackRock are in this stock, and while some are trimming, others are adding or maintaining huge positions. The key takeaway is the sheer stickiness of institutional capital in a stock that has fallen so dramatically. They are playing a multi-year game, and their calculus hinges on the operational reality of Plug's new hydrogen production plants finally coming online and scaling up. The market's short-term focus is on the quarterly losses and the current negative free cash flow, but the institutional bet is on a massive step-change improvement in gross margins when the company transitions from buying expensive third-party hydrogen to self-supplying from their lower-cost, purpose-built green hydrogen plants. The recent news of the company successfully raising $370 million from a warrant inducement transaction is a great example of this. On the surface, it's more dilution. Deeper down, it's a strategic financing move that shores up the balance sheet and funds the final stages of their hydrogen plant build-out without the chaos of a full secondary offering. For a sophisticated individual brokerage account holder or someone using a platform like Interactive Brokers Trading to track deep institutional sentiment, this nuance is everything. It suggests the institutional players view the dilution as a necessary cost to secure the massive future production investment. The company's core business model is a two-pronged attack. The material handling business, forklifts, which is a stable revenue base with known large customers like Walmart and Amazon, and the rapidly expanding hydrogen investment infrastructure, including electrolyzers for industrial applications and stationary power. The historical reports show a company that has consistently grown revenue year over year, but has simultaneously seen losses deepen due to the enormous capital expenditures required to build this green hydrogen network. The revenue growth is not the problem. The negative gross margins and operating losses are. Their gross margin was deeply negative in the last reported quarter, a brutal reality that keeps the stock price grounded. However, management is adamant that as their internal hydrogen plants start producing cheap, captive hydrogen for their fuel cell customers, that margin profile will correct sharply. This is the ultimate expectation versus reality disconnect in this stock. The expectation is that they keep losing money. The internal reality they are promising is a massive, sudden improvement when the facilities in places like Georgia, Tennessee, and New York start producing green hydrogen at scale. The risk for the Fidelity or SoFi Invest user is trying to predict the exact quarter that flip happens. Sector momentum is also a significant tailwind and a source of the stock's recent volatility. The entire green energy sector is subject to the whims of legislative cycles and macroeconomic pressures, particularly interest rates, which punish growth companies that need constant capital. However, Plug Power has recently benefited from an unexpected narrative: the intersection of hydrogen with NVIDIA stock-fueled AI infrastructure. Large data centers consume colossal amounts of power, and one increasingly discussed application for fuel cells is providing reliable, stationary backup or primary power for these energy-hungry operations. This narrative, while speculative and still in its infancy, provides an unexpected new addressable market, moving the conversation beyond just forklifts and trucks. This is a subtle but crucial change that gives the Plug Power stock story a whole new dimension, adding a fresh layer of expectation to the traditional industrial applications. Furthermore, the global push towards decarbonization means that not only are U.S. tax credits potentially a massive financial boon, but international partnerships, such as those in Europe and even the recent announcement regarding a partnership in Uzbekistan, demonstrate a global scaling effort that goes beyond the immediate U.S. regulatory environment. Looking forward, the future outlook for Plug Power stock hinges on three key catalysts. First and foremost is the successful, on-time and on-budget commissioning of their major green hydrogen plants. Any delay here is a major risk, as it pushes out the gross margin inflection point. Second is the clarity and finalization of the Section 45V clean hydrogen production tax credit guidance from the U.S. Treasury. While the $3 per kilogram credit is the expectation, the technical requirements for what qualifies as clean are still being debated and could drastically affect Plug's unit economics, a point of high tension for investors. The reality here is that the guidance could either be a massive shot in the arm or a frustratingly high hurdle. Finally, the third catalyst is the expansion of their electrolyzer business outside of their internal consumption. Selling electrolyzers to other industrial players, essentially selling the tools for the hydrogen economy, is a high-margin business, and a few large deals could move the needle far more quickly than the slower, steady growth of the material handling segment. Investors who use tools like Schwab Intelligent Portfolios or the Fidelity trading platform for market research need to be tracking these regulatory and operational updates with extreme prejudice. The inherent risk, however, remains acute. The company is burning through cash at an incredible rate, and while the recent capital raise helps, a prolonged delay in reaching positive gross margins will inevitably lead to more dilution. Competition is also heating up, particularly from companies like Bloom Energy, which some analysts view as having a stronger financial footing and more favorable near-term profitability metrics, as well as the long-term established players like Apple stock and Tesla stock, who have the capital to disrupt any clean energy market. For the Invest Online user, it's a tightrope walk. You are betting on operational execution over a short period of time to justify a market valuation that is based on massive future profitability. The long-term investment thesis remains that hydrogen is an indispensable piece of the world's decarbonization puzzle, especially for heavy-duty mobility and large-scale industrial use where batteries are less viable. Plug Power has the market share, the foundational customer relationships, and the vertical integration strategy to win, if they can survive the capital-intensive scale-up phase. In summary, the core market expectation is that Plug Power stock is a highly speculative, perpetual cash-burning stock that is dependent on unproven future government subsidies. The deeper reality we've uncovered is that sophisticated institutional money is placing a high-conviction bet on a specific near-term operational event, the scaling of the company's internal